Welcome to Capitalize Your Finances, the podcast that's your ultimate guide to mastering personal finances and unlocking the secrets of entrepreneurship. Each week, we dive into the world of personal finance and business development and have fascinating conversations with industry experts, seasoned entrepreneurs, and thought leaders who share their insights, strategies, and stories to help you get ahead in life. Whether you're a seasoned entrepreneur looking to scale your business or someone just starting out on your financial path, this podcast is your go-to resource for inspiration and actionable insights.
Welcome back to Capitalize Your Finances. As always, I'm your host, Christopher A. Poniotu, certified financial planning professional, the Cap and Capitalize. And on today's episode, I'm going to get into 6 popular moves that people make before required minimum distributions are due at the end of the year, even though we're recording this at the beginning of the year because I want you to get ahead of it. But I'm also going to give you my take on if this popular advice actually holds up. But as always, before we get into it, the free advice for the week. There's no such thing as no risk. So once you've accepted that, you will see the world of money in a positively different light. So just marinate on that one for a while. And after you're done marinating, we will get into the meat of this episode, because when I was writing this and I was thinking about it, because the year had just finished. We're in the year of our Lord and Savior, 2026. And normally people wait to the very last minute to figure out required minimum distributions and strategies around that. And for those of you that are new to the show and new to just personal finance in general, first off, welcome. But required minimum distributions are something that you need to take from your IRA when you are 73. And they've been bumping that age up over the last couple of years. But the point that you need to know is once you get to 73, it doesn't matter what the balance is of your retirement plan, your IRA, when you roll it over, when you retire. The percentage is it's the same. It's about 4%, and then it slowly increases every year. And, good news is, you have to take it. You've lived for it, retirement, all that fun stuff. But the bad news could be that you're in a high tax bracket at that point, and you don't want to be paying more in taxes as much as you need to. So what I'm going to do during this episode is I'm going to list each strategy off. So I'm going to first read the strategy, why it's most popular, and then I'm going to give you my take on if the popular advice is quality or not. As I just want to remind you, just because there is popular advice out there, that does not mean it's right. So one thing that you need to know too, just because with required minimum distributions, I'm probably going to stutter a couple times over this. I mentioned this in the episode last time. We're still getting used to the lack of sleep with our second newborn baby girlie. Also, we've hit the 3-age years with our daughter, so that's loads of fun. Love them both to death. But for those of you that are parents, you know I'm on the metaphoric and literal front lines. So that's just a little side note. So just because RMDs start at 73, that does not mean that you need to wait to 73 and then just figure it out. So for those of you that are in your 60s and you retire in your 60s, even if you're in your late 60s, you have a few years to game plan, in some cases, seriously game plan, to see what you can do to minimize your taxable situation, and in some cases, avoid taxes altogether. And we'll get into that later in this episode. So the first popular move that I want to bring up with RMDs is Roth conversions. So this is a classic way to reduce future required minimum distributions. As you're taking money from your IRA, which is pre-tax, you're paying the tax today at ordinary income tax rates, and then you're converting it to Roth, which is after tax. So by the time you get to 73, your required minimum distributions won't be required, because again, Roth IRAs do not have required minimum distributions attached to them. So when you're doing this, you're paying the tax during that conversion, and you're allowing that money after that, once it's in Roth, to grow tax-free. And if you've retired and you're delaying Social Security, there may be a window where it makes sense to convert some of your IRA money as your income may be a bit lower. Now, here's my take. This is true. This is all very true. Personally, I think Roth conversions are for splitting hairs. If you've saved up a sizable nest egg in retirement, unfortunately, but really unfortunately, you're going to be paying a boatload in tax no matter what, and regardless of how hard you try. Also, the standard deduction is pretty sizable today. Plus the senior deduction from the Tax Cuts and Jobs Act, and that became permanent in 2025. Plus the state and local tax deduction, especially if you live in a state where there are, state and local taxes. That limit went from $10,000 to $40,000. So there's already a ton of easy things that are built into the tax code where you can take advantage of that. And the Roth conversion, it can kind of be an afterthought. Again, I'm in favor of these. I'm just saying that there's a lot more to it. And there's a lot more already built into the current fiscal landscape where you're probably going to be in a lower tax bracket than you imagine in retirement. So the whole Roth side of things, okay. How do you like that? Now, number 2, tapping traditional IRAs first. So this is an extremely easy way to reduce future RMDs. Drain your IRAs first. This gets your highest taxable money spent down first, while also allowing Social Security to be delayed, which will help your tax situation further without getting into that. Now, here's my take on this. I am massively in favor of this strategy, and I call this front-loading your retirement. And so really quick, if you think of the main 3 types of accounts, pre-tax, taxable, and tax-free, you could locate your money, and I refer to this as asset location, and I talk about this in my first book, where you not only are investing money within each account, but you're investing it with tax efficiency in mind, as well as rate of return in mind. So when you retire and you've spent your IRA money down first, let's just assume the middle tax bracket is 25% ordinary income for IRA. And then the next tax bracket we're talking about for capital gains would be 15%, and then Roth is 0. So by spending your IRA down first and then taxable and Roth, you're actually walking down the tax stairs in retirement. So not only are you paying less and less and less in tax because you're in a lower tax bracket, your net worth is actually increasing over time. It's a double whammy in a very cool way. On top of that, a little cherry on top, I should say, there's an estate planning vehicle in that too, because if you inherit an IRA, you have to take money out within 10 years, and that's going to be just a fat ordinary income tax bump if those do inherit IRA money. But then taxable money, you get a step up in basis, so that's all tax-free. Roth IRA money, you still have to distribute it over 10 years, but what I personally love to do if a client inherits Roth IRA money, assuming they can do this, is you delay that distribution until the 10th anniversary because all of that gain and growth is tax-free as well. So to conclude, this is a big yes for me. Number 3, Roth 401k contributions. So making Roth 401k contributions can help reduce people's RMDs as you're rolling it into a Roth IRA when you retire, most of the time, and that does not require a required minimum distribution. And again, that I'm going off my statement earlier. And it's also worth mentioning that Roth 401ks are not subject to RMDs. So my take, I'm torn on this one because it depends on a number of factors. Age, income, various other investment accounts, type of investments within each account. If I had to give a blanket statement regarding yes or no on this one, I would say yes because, again, just black and white, this does in fact lower your RMD, but in terms of this being the best option, given too many variables, I'd give it a big ol', it depends. It depends. Okay. So we're going to take a quick commercial break. And when we come back, we're going to close out with the next 3 popular moves to make before you hit RMDs. Don't go anywhere. Stick around.
Are you ready to transform the way you approach sales? This episode is sponsored by the second book in the Capitalize series, Capitalize Your Sales, the all-in-one sales framework that saves you from ever struggling again and teaches you how to sell with sincerity, which dives deep into the art and science of driving sustainable growth. Packed with strategies that go beyond surface-level techniques, this book will help you understand what it takes to truly connect with clients, build long-term relationships, and close deals. Whether you're looking to fine-tune your sales craft or break through to the next level, Capitalize Your Sales offers a roadmap to success designed for today's fast-paced business world. Head on over to your favorite bookstore, order today, and start capitalizing your sales immediately. And now, back to the episode.
Welcome back from the commercial break. We're going to get right into number 4 of the 6 popular moves to make before required minimum distributions, RMDs. Qualified charitable distributions, QCDs for short. So these are ways, or qualified charitable distribution, I should say. These are ways. I don't even know if that's right, if that's proper English. Doesn't matter. Qualified charitable distributions are for those of you that are 70 and a half, and you can make a charitable donation through a tax-free direct transfer from your IRA or your 401k to the qualified nonprofit, 501c3 eligible nonprofit or charity. And the limit in 2026, it's bumped to $111,000, and that's up from $108,000 in 2025. And this is going to be indexed every year to inflation thanks to the Tax Cuts and Jobs Act. Now, if you're not at the required minimum distribution age, which is 73, using a qualified charitable distribution will reduce your IRA balance, which will also reduce the overall amount you need to take come age 73. If you can't itemize for tax purposes, which most people don't because the standard deduction is just so high today, this also helps serve as a tax-efficient way to make charitable contributions. Once you're 73, qualified charitable distributions can help cover some or all of your required minimum distribution, which you have to take. And again, this is tax-free from an otherwise ordinary income taxable account. Now, you have to know that you should take this and make sure it counts towards your RMD, because just because you do it doesn't mean it always counts towards your RMD. And if this is beyond your required minimum distribution amount, it'll still reduce your IRA balance in the amount of future RMDs, but it may not be as tax efficient. So if your RMD was 50 grand, but you wanted to do $111,000, you could do it. It may not be the most optimal thing for you. So my take, as promised, it's a huge yes for me. Huge yes. And I use this all the time for clients in my business. And you know, some of our clients, I mean, look, I'm blessed to work with some pretty awesome people, and they've done very well financially. And some clients that we have, they have IRA money that they just don't need due to maybe they sold their business and that's where the majority of their net worth was, or maybe they've just invested well and they've got stock options and all that. So their IRA, 401k, but rolled to an IRA, it's not an afterthought, but it's not, they don't need it from a living perspective. So using a qualified charitable distribution strategy, it helps them not only be charitable, but they're avoiding that tax that they otherwise would have to spend. And again, $111,000, that is per person. So if a couple comes in, $111,000, they could take $222,000 of RMDs, convert it. And I'll tell you, at that tax bracket, you're probably in, just assuming everything else is going on, 30% bracket. So by taking 222 and taking that, whatever it is, 30% tax bracket, you're saving yourself just a bit over 60 grand in taxes you otherwise would have to pay. That's a big deal. So use it if it's appropriate. The fifth most popular move to make before RMDs are QLACs. I haven't used this term in a long time. Qualified longevity annuity contracts. These are deferred annuity contracts that you can buy inside your 401k or IRA. And you can use up to, in as of this recording, I haven't gotten the 2026 numbers yet, but as of 2025, you could take up to $210,000 to buy one of these. Again, it increases for inflation every year. So I would call it $215,000 in 2026. But again, just, going off of confirmation, 2025 is $210,000. It's going to be a little bit more than that. Now, this amount that you buy is removed from your RMDs until the age you've selected to start the benefits from the annuity. And that is delaying up until age 85. Once you start it, this will be included in your RMD each year. Now, aside from decreasing your RMDs, these can serve as a safety net to help you not only outlive your retirement assets, and this is just more annuities in general. These are also, because they're guaranteed streams of income once started, assuming you go with a lifetime income annuity. And I'm not going to get into all the types of annuities. We've done that in the past. Now, it's worth noting for married couples, you can use a joint contract. So when one goes, the other keeps the income going until the second meets Jesus, even if it's in just one IRA. Now, here's my take. I feel the same way with QLACs as I do with Roth 401ks. It depends. I've used these in my practice in the past, and I still do from time to time. I can say that on paper, it sounds great. Administratively, the juice isn't necessarily worth the squeeze. Do it, but you just got to know what you're getting yourself into. And then number 6, this is not going to be a popular one, but it is a popular move to make for RMDs. Keep working. So with a 401k plan, there's something known as the still working, quote unquote, exception. So you can't own 5% or more of the company you are working at, and your company 401k must allow for the deferral of RMDs. So if all of this checks out, you can keep working, you can keep contributing to your 401k, and keep deferring the RMD from your plan. This does not count for IRAs or previous 401ks that you have from previous jobs. So a strategy that you could use is you could take your IRA and previous retirement plans and roll them into your current retirement plan, your 401k, or 403b or 457b, that allows for this, and then defer all of that RMD. So really, really valuable stuff. But as always, I have my take. And my take, in reality, not a huge fan 98% of the time. It's kind of in the title, okay? And that's why it's not the most popular. You got to keep working. So just to be really black and white and obvious, clients want to retire. People want to retire. So that's why they've saved all this money to begin with. And at the end of the day, you're not going to go to your deathbed regretting that last bit of deferral. Yes, this is valuable, and it is a completely valid. It is a completely valid strategy if all of the things align. But in my personal take, retire already and just enjoy your life. So that does it for today's episode. As always, I am your host, Christopher A. Paniotu, certified financial planning professional, the Cap and Capitalize. And until next time, keep capitalizing. Take care. As always, thank you for joining me today. If you have questions about today's episode or any personal finance questions, please reach out to me at Cap and Capitalize on Instagram, Chris at capitalizeyourfinances.com, or via our website, capitalizepodcast.com. If you want more Capitalize Your Finances content, head on over to capitalizepodcast.com and check out our blog, free resources, book, and online course. As always, I'm your host, Chris Panayiotou, Certified Financial Planning Professional, the Cap and Capitalize. And until next time, keep capitalizing.
The information provided should not be considered specific tax, legal, or investment advice and is not specific to any individual's personal circumstances. Each taxpayer should seek independent advice from a tax professional based on his or her individual circumstances. These materials are provided for general information and educational purposes based upon publicly available information from sources believed to be reliable. The information in these materials may change at any time and without notice, and its accuracy cannot be guaranteed. There is no guarantee that any investment strategy will meet its stated objective. All investments involve risk, including potential loss of principal. Traditional IRA account owners have considerations to make before performing a Roth IRA conversion. These primarily include income tax consequences on the converted amount in the year of conversion, withdrawal limitations from a Roth IRA, and income limitations for future contributions to a Roth IRA. In addition, if you are required to take a required minimum distribution in the year you convert, you must do so before converting to a Roth IRA. IRA withdrawals will be taxed at ordinary income rates. Withdrawals prior to age 59.5 may also be subject to a 10% penalty tax. Roth IRA distributions of principal from a Roth IRA are tax-free. However, any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth IRA was established, whichever is longer. 401k benefits may be subject to change at your employer, the governing pension, or benefit organization's discretion. A plan participant leaving an employer typically has 4 options and may engage in a combination of these options. 1. Leave the money in their former employer's plan, if permitted. 2. Roll over the assets to their new employer's plan if one is available and rollovers are permitted. 3. Roll over to an IRA. Or 4. Cash out the account value. Distributions of principal from a Roth 401k are tax-free. Any earnings will be taxed at ordinary income rates, and a 10% penalty tax will apply if withdrawn prior to age 59.5 or within 5 years of the date the Roth 401k was established, whichever is longer. Your investment options are limited with a Roth 401k to those offered by the plan administrator. Charges and fees may be incurred. Examples cited are hypothetical, are for illustrative purposes only, are not guaranteed, and subject to potential federal and state law amendments. There is no guarantee that you will achieve the results discussed or illustrated. Annuities are long-term investment products designed for retirement purposes. Guarantees are based on the claims paying ability of the issuer, subject to their terms and conditions. Early withdrawals may be subject to surrender penalties, and if taken prior to age 59.5, may be subject to an additional 10% federal tax. Annuities are not FDIC insured. Certain terms and conditions apply, so please read insurance company materials carefully. Before investing, carefully consider a variable annuity's investment objectives, risks, charges, and expenses. To obtain a prospectus or summary prospectus which contains this and other information, call your financial advisor. Read the prospectus carefully before investing. Variable annuities with guarantees are available through optional riders at additional cost. The information provided is based on current laws, which are subject to change at any time. Capitalize Your Finances is not affiliated with or endorsed by the Social Security Administration or any government agency. Social Security rules can be complex. For more information about Social Security benefits, visit the SSA website at sai.gov or call 800-772-1213 to speak with an SSA representative. Christopher Panayiotou is a registered representative with, and securities and advisory services offered through LPL Financial, a registered investment advisor, member FINRA SIPC. Capitalize Your Finances LLC is a separate entity from LPL Financial. Capitalize Your Finances is not registered as a broker-dealer or investment advisor. CRPS conferred by College for Financial Planning. LPL Financial Insurance License number 0518721. LPLIA Insurance License number 0B91442.